This is a video to explain option 2 of our engulfing candle strategy. So this strategy is best used as like a B, like a plan B option to the engulfing candle when you don't see a viable setup for the engulfing candle strategy. Just to recap, the engulfing candle strategy is basically where you're looking for an engulfing candle that's going in the same direction as trend, and then a sharp move that follows trend, and then basically for price to come back up to the open of the engulfing candle, thus giving you your entry. And this was actually a very good one this morning. So from there, let's say that there's no more opportunities in this chart for a sell potential, or there's no more engulfing candles to trade off of. What do you do? And this is what the strategy is going to actually help you to be able to always have a game plan for your next trade for every pair that you're trading. So here's how it works. You're not going to have to change your chart up. You're going to use the same moving averages, but what you're going to do is, just like the engulfing candle video, you're using the moving average to determine trend. But right now, Euro GBP is in a selling trend. So this is what you do to wait for your next buy. So the first thing that's going to have to happen is that the green line is going to have to cross the red line. That's the first thing that's going to have to happen. Then, because this is a potential buy, is you want price to break a resistance. Want price to break a resistance. So it breaks the resistance here. And then from there, what you want is for price to actually break the resistance, retest the broken resistance as support, and then there would be your entry to buy up. So to recap, the moving averages have to cross in the opposite direction. So if you're in a selling trend or in a downtrend, you want the moving averages to cross back up. And if you're in a buying trend, you want the moving averages to cross down. If the moving averages cross up, the second thing that you want to happen is that price breaks the next relevant resistance. So this right here would be the next relevant resistance, because you see there's a lot of respects of price and price moving down off of that multiple times. So when price breaks it, then it's a break of that trend, like a second confirmation for that. And then all you have to do is wait for price to retest and hold that resistance, now turn support, and then start to move up. And then on that little, impulse up, that small impulse, that's when you get in for your buy. So as far as targets, what you want to look for is this was, going to be maybe like a 30-30 type of trade for your first take profit. You can do that, or say if there's some wicks, like price makes something like this. Let me see if I can kind of give you an idea. Something like this right here goes up, and then there's some wicks. Let's just say, let's close this out, delete that, and delete that so you can see it. Let's just say right here, they're wicks. So these are wick candles, kind of congregating right there. Those are wicks. What you want to do is you want to move your stop loss below those clusters of wicks that are going in a downward direction. So there's wicks here. So what that's letting you know is that there's buying interest in that area. So if you see a cluster of wicks, then you can put your stop loss below those wicks at a decent area, somewhere between 20 to 30 pips. And that'll be your risk, and your target can be either the next zone. So if I'm using the next relevant zone, you can be here, or it can just be a flat amount of maybe 25 to 30 pips. That's for your take profit one. Your take profit two would be just double your take profit one. So If you're doing the zone to zone trading, you're going for the next resistance point, which would be here, or you're just going to go for 60 pips, which is going to be, mathematically, the way charts are set up, the market's set up, it's going to be pretty close to another resistance point anyway. So that's how you would do your option 2 trade. So let's look at some scenarios of that so you understand, what we're talking about. So let's go right here. It's a perfect one right here. So price was in an uptrend. There really wasn't much going on as far as engulfing candles, like especially at this point, there really wasn't another engulfing candle. So what you're waiting for, and let's do this so you can see it better. So what you're waiting for is you're waiting for price to break a support and also cross back down. You want the moving averages to cross down. So as it's starting to move down, price is going to move down with it. And what you're going to get, that was a mistake. What you're going to get is something like this. So let me mirror that so you can see it. What you're going to look for is something like this, where price comes and then retest that line. So you got the price breaking the support. The moving averages are crossing back down, and then you're looking for that retest. And then from there, that's when you're looking for, your next move down, which a lot of times may not be that deep of a move. It may be more like this. So what you're looking to target is, you see how there's wicks right here. So let me delete those yellow lines again so you can see it. There's a cluster of wicks in this area. Let me zoom in so you can see exactly what I'm talking about. So you see how there's wicks right here. So what I would do is place my stop loss above, that little area of wicks. So if I go back out, I have a trade here, which, look, it happens to be 30 pips, just like that. Next one, either you're going to do 30 pips, 25 to 40 pips, whatever you like, or you can do the next major zone for your first take profit. So this would be your first take profit here in this zone. And then the second major zone, which would be right here, we extend that out. We extend that out there, and that can be your second take profit. So you have a 3-to-1 trade on your second take profit. A lot of times you're going to have a 1-to-1, a 1.5-to-1 trade for your first take profit. And then what it eventually do, we play that out. Where is that? Play it out here. Look, it plays right out to it. So you would have won there. Your first take profit would have hit there. Let's see if it hits the second. Oh, it does hit the second. So that would have been your second take profit. And you would do this until you find another engulfing candle. So if I delete this out, here. There's really no engulfing candles here yet. But maybe if I keep going, there is one. If there's not, you got other pairs to trade, so there's no big deal. There we go there. So there really wasn't another entry there, but you see what I mean as far as the option 2. You may not get a engulfing candle entry every time you look at a chart for every pair, but you have an idea of where you want to be in the markets, and from there you're able to find your opportunities and find your places where you can interact with the markets. So remember, option one is the engulfing candle strategy. Option two is waiting for the moving averages to cross in the opposite direction of trend, break a major zone, and then retest that zone as support or resistance, depending on which trend it just broke, and continue in the new trend. So hopefully this video helps out. Definitely watch it a few more times to understand it, but catch as many pips as possible and let's make some money.